Hello friend, I'm CA Manish Mishra and in this video we are going to discuss about non-residence taxation in continuation of our first video which was on residential status section 6 of Income Tax Act 1961. Today we are going to discuss section 5 and section 9 which is very important section for the taxation of non-residents. So before we move ahead to our today topics, let's have a quick recap of our last topic that we discussed, the residential status. Now we understand in cross-border transaction that basically there are two rules based on which taxation takes place. The first rule is residence-based and the other one is source-based taxation. So when we say residence-based taxation, your income is taxable based on the country you are resident of. So irrespective of your source, income generating source, you would be liable to pay tax in a country of residence. Similarly, as the name suggests, source-based taxation is basically your income get taxed in a country of income generating country irrespective of your residential status. So few income are there which would be taxable in the country of source. Moving further, filing income tax return or for any tax planning for non-residents, knowing their residential status is quite important. Why it's important? Because taxation thoroughly depend upon the country in which you are residents of. If you are not in a residence of India, certain income of even if it get generated outside India or from Indian source would not be taxable or maybe taxable based on the different rules and criteria. So what is important that we have to determine the residential status of a person. So let's see what section 6 says. There are two primary conditions which is based on your residence in India, number of days you are in India. Only those two rules would be considered to be a residence of India. The first condition is section 6 of section 1 clause A, which says that if you are in India for at least 182 days in previous year, then you are a resident of India. Now clause C, there is another clause, section 6 subsection 1 clause C, which says that if you fail the first test and if you were in India for at least 60 days in previous year and 365 days in last preceding 4 previous year, then you are residents. So you need to satisfy either of this condition to be residents and ordinary residents. If you fail to satisfy any of these, then you are a non-resident. Now it is to be noted that only individual and half can be residents but not ordinary residents, or residents but ordinary residents. Rest all the SSC, whether it's a firm, organization, company, LLP, they are residents and non-residents. There are only two categories for rest of the SSC. So now we just understood that for individual and half, if they were in previous year in India for at least 182 days, they would be considered residents. Second condition, if you fail the first test, then if you were in India for at least 60 days in previous year and preceding 4 previous year 365 days, then you are a resident. Now what kind of people then we consider residents but not ordinary residents? Now we already understood that if you fail to qualify or fulfill any of the primary condition, you are a non-resident. So now we are talking about RNOR, residents but not ordinary residents. If you are non-residents in 9 out of 10 preceding previous year, you would be considered residents but not ordinary residents. If your stay in India doesn't exceed 729 days in last preceding 7 previous year, then you would be considered RNOR. Now the third condition, if your income is above 15 lakh rupees, this is a new situation based on the income has been devised by the Income Tax Act 1961 introduced through the Finance Act, that if your income is above 15 lakhs from the Indian source and if you come to visit India and if your stay is between 120 days to 182 days, then you would be considered RNOR. So these are the three conditions by which anyone would be considered residents but not ordinary residents. There is another section that has been introduced by the Finance Act 2020, which is section 6 clause 1A, which says that if your Indian source income is 15 lakhs or above and you are not a tax resident of any other country or any other territorial and you are not paying taxes anywhere in the world, then irrespective of your stay in India, even if you stay here for one day or you doesn't stay even here for even a single day, your income will be taxable and you would be considered residents but not ordinary residents. So these are the concepts that we just discussed, and you can also visit my last video which has very precisely explained that how we can determine the status of for the individual or half, that whether they are residents but not ordinary residents and non-residents. It is very important that I would like to focus the new concept that has been introduced. This 15 lakh rupees will make you residents, non-residents and residents but not ordinary residents. Let me tell you, if your income is less than 15 lakh rupees and if you stay here in India for at least 182 days in previous year, you will be considered residents and ordinary residents. If your income is above 15 lakh rupees, your stay in India in previous years is somewhere between 120 days to 182 days, you would be considered RNOR, ordinary residents. And if your stay here is less than 120 days, your income is above 50 lakhs from Indian sources, you would be considered non-resident. Now, as we just discussed, that only individual and half could be residents and non-residents. Rest all the SSC, whether it's a firm, LLP or company, they would be considered residents or non-residents. Now, it is to be noted that every company which is registered in India would be considered, generally they are residents of India. Similarly, foreign company, if they have a place of effective management in India, then they would be considered residents in India. Moving further to our next topic, which is scope of total income, section 5. Why it is very important? Because as we initially discussed, that certain income which is taxable for residents would not be taxable for non-residents and would be thoroughly exempt for the residents but not ordinary residents. So let's understand how this takes place. If you are a resident but ordinary residents, any income received or deemed to be received in India would be taxable. Income incurring or arising in India would be taxable. Any income accruing or arising outside India, even your global worldwide income would be taxable because you are a resident of India. Now one may raise a question that if my USA or Dubai or UK income is taxable, it doesn't make sense because I get those income after deduction of WST, withholding taxes. I mean, once you earn income in Dubai or maybe any part of the world, generally they deduct TDS and then the rest amount is processed. So as we initially discussed, that in a cross-border transaction, generally all the company have a DTA agreement. So India also have agreement with different countries, that is double tax avoidance agreement, where this scenario is covered, that which income is taxable in which country. So generally DTA is having provision for those income which is generated out of India, so that the taxpayer doesn't have to pay twice on same income. So one need not to pay double taxation on same income. Let's take an example. Even if they do not have a DTA agreement with the concerned country or concerned judicially territory, then under section 91 of Income Tax Act, one may get unilateral benefit. They will get the credit like that we get here in India, credit of taxes that has been paid outside India, equivalent credit of the taxes that has been paid outside India. So anyway, the tax authority ensure that you will get credit. Moving ahead, now we'll be discussing section 5, scope of total income. The next, we just discussed ROR. Now we are discussing RNOR, residents but not ordinary residents. Similar to the ROR, every income of residents but not ordinary residents would be taxable here in India, apart from any foreign income. Any foreign income which is independent of Indian sources would not be taxable for the residents but not ordinary residents. So moving ahead, if you are a non-resident, only your Indian source income would be taxable. So if I am a US citizen, I am having certain income from India, I would be liable to pay taxes on total income. But since I am a US citizen, I do have income from the United States as well. Those income would not be taxable here in India because I am a non-resident. I am not a tax resident of the India. So because of this only Indian source income would be taxable. So even if there is any nexus or this has been planned in some way, that we already know that tax department or taxation system look for substance over form. So if there is any nexus, the tax would be payable based on Indian source income. So moving to our next topic, which is very important, income deemed to accrue and arise in India, section 9. Now there's a classic example of Vodafone case that one may refer, which is on international taxation and basically on section 9, that what kind of income is deemed to accrue and arise in India. Even they may actually accrue and arise outside India. Like I'm an Indian citizen, I'm an employee of Indian Embassy, I'm working in United States of America. Since I am working in USA, but salary is given by the Indian government. So these kind of income is irrespective of where it is accrue and arise, this is always be deemed to accrue and arise in India. So let's see the first thing that we are going to understand, what kind of income is deemed to accrue and arise in India, even if they actually accrue and arise outside India. The first is, if those income is generated from any business connection in India, or any property or asset which is in India, or transfer of any capital asset which is situated in India. So basically it's a very, very important topic. Now understand, I am a company registered in United States of America, but my asset is situated in India, and I sold that company because I am a USA company. I sold those company to someone in UK, but the capital asset is situated in India. So US citizens sell that company to the UK. Will that be taxable? After Vodafone verdict, yes, it is taxable because this entire transaction has a capital asset and that asset itself is situated in India. So if there is any nexus, any connection in India, property is in India, whether it's a tangible, intangible, movable, immovable, or that would be considered income deemed to accrue and arise in India, irrespective of whether it's arising outside India. Other scenario is salary earned for services rendered in India. Any salary that has been earned by rendering services in India, even if you receive outside India, that would be considered deemed to accrue and arise in India. As we already discussed, salary payable by Government of India is always deemed to accrue and arise in India. And the last one is, if dividend paid by Indian company outside India, that will always be deemed to accrue and arise in India. Now we'll be moving ahead, that what is deemed to accrue and arise in India. There are generally interest, royalty and fee for technical services. It's paid by residents or non-residents or government. And if those services, I mean the fee that I'm paying for the royalty or fee for technical services, or the capital that has been invested, or interest on which the capital has been invested in India, then it is always to be deemed to accrue and arise in India, irrespective whether I am paying to a non-residence, or government, or residence. So what we understood, that if I have borrowed a capital invested in India, whether it is from the government, non-residence or residence, if the investment is in India, if the services have been utilized in India, that income, interest, royalty or fee for technical service always deemed to accrue and arise in India. If I have borrowed from the government, residence and non-residence, and investment has been done outside India, then that is out of the scope. Now, if there is income arising outside of India, being any sum paid by non-residents without consideration, which exceed 50k, it's a deemed taxation. We understand that we have seen this in capital gain taxes also. that if the value of gift is exceeding 50k, then that will be deemed to accrue and arise in India. Now moving ahead, we understand that now we'll understand significant economic presence. Why we need to understand significant economic presence? Because we already discussed, if any income which is generated in India, or even if generating outside India but having nexus with Indian source, then it will be considered income deemed to accrue and arise in India. To cover those scenarios, because now we understand nowadays lots of technology companies works, like Google, or for that matter Amazon, or there are so many companies, they do not have any physical presence in India, but they are providing services all over India. To cover those scenarios, this significant economic presence has been prescribed by the Act. Now what it says, that non-residents with any person in India, if you have a business connection in India, non-residents with any person in India, so if you are dealing with goods, services or property, including downloading of data or software in India, if non-residents connect with any Indian residents for any services, good or property, including the downloading of data or software, if the value exceed 2 crore, then it would be considered that this particular activity has significant economic presence in India, nexus with India, and those income would be deemed to accrue and arise in India. Similarly, for advertising company, like systematic and continuous soliciting a business activity or engaging in interaction with users in India, if the subscriber or user base exceed at least 3 lakh, or there is at least 3 lakhs user, then it will be fall under the category of significant economic presence. So like the Google advertisement that most people do, if the number of user connected is more than 3 lakhs, then it will be considered that they have the significant economic presence. And once it is established that you have a significant economic presence, your global income will be deemed to accrue, and this particular income which having nexus with India would be deemed to accrue and arise in India, and it would be taxable. Now moving ahead, there are certain exceptions. There are certain relaxation that these particular income not deemed to accrue and arise in India. What? Like for the purchase of goods for export out of India. If you purchase any good in India for export purposes, this activity would not be considered Indian nexus. This would not be considered Indian activity and would not be considered deemed to accrue and arise in India. Similarly, if you are collecting news and views in India for transmission outside India for news channels or news agencies, obviously this activity is in exclusion list. This kind of activity would not be considered Indian activity. Similarly, shooting cinema films in India, or activities confined to display of rough diamond in a special non-economic zone is outside of scope of deemed to accrue and arise in India. Now we already understood income from property, asset or source of income in India. If income arising from any property in India, whether it's a movable, immovable, tangible or intangible, which would be deemed to accrue and arise in India. Income from transfer of capital assets in India is again deemed to accrue and arise in India. Now we'll understand section 9 subsection 1, which says shares or interest in a company or entity registered or incorporated outside India shall be deemed to derive its value substantially from the asset located in India if on a specified date value of Indian asset is more than 10 crore or at least 50% of the value of the asset owned by entity. So as we just discussed, a company registered in USA, or this clause is basically this explanation 6 of section 9 subclause 1 is applicable for M&E, multinational entity, which is having businesses in multiple company. They would only be considered that they are driving value from Indian when their asset value is more than 10 CR, or they have at least 50%, they are driving 50% of the value of their asset from the India. So either of these would be make them a nexus with India, and they would be considered that they are driving value from the India if their 50% of asset is located in India or the value exceed 10 CR. Moving ahead, interest. Now we already discussed that if interest deemed to accrue and arise in India, if it is paid by any interest paid by government, residents or non-residents, if used for the business and profession in India, this would be considered income deemed to accrue and arise in India, and it would be taxable in India. It would only be not taxable when the investment has been done outside India. Then there is no nexus with India and it would not be taxable. Similarly, royalty, as we already discussed, if royalty will be paid deemed to accrue and arise in India, if it is paid by government, residents or non-residents, and in which this business and profession it has been where it has been royalty has been used is invested in India. If it has been invested in India, then this is deemed to accrue and arise in India. Similarly, if the now we all understand royalty is paid on the patent, invention, design, model or trademark. So these activities, if they have been used in India and payment has been done by the government, residents or non-residents, it would be considered a nexus in India and it would be deemed to accrue and arise in India and taxable in India. Similarly, fee for technical services. If income is paid by the government, residents and non-residents, and services have been used for business and profession situated in India, this would be considered income deemed to accrue and arise in India and it would be taxable. As we already discussed, any interest, royalty and fee for technicians will be taxed irrespective of territorial nexus. Now we'll be discussing section 9 subsection 1 clause 8, which says any sum of money paid by a resident Indian to a non-resident, non-corporate or a foreign company or a residence but not ordinary residence, and if value exceed 50k, this would be considered income deemed to accrue and arise in India and taxable in India. Now there are certain exemptions under section 10 that interest on money standing to the credit of individual in NRE account would be exempt. So if you are a non-resident, any income accruing in your NRE account, any interest which is credited in your NRE account, that would be exempt from taxation under section 10 subsection 4 clause 2nd. Similarly, interest income of non-corporate, non-residents or a foreign company on a specified rupees denominated bond issued by Indian company or business trust would be exempt. Similarly, any specified fund on transfer of certain assets section income would be exempt under section 10 clause 4d. Similarly, remuneration by foreign government employee for specified training in India would be exempt and would be exempt for non-residents. Now we'll be discussing section 10 subsection 6 clause 6, which says remuneration received by foreign national as an employee of a foreign enterprises for services rendered by him during his stay in India is exempt from tax. There are certain conditions. If company not engaged in any business or trade, stay doesn't exceed 90 days, and remuneration not deductible under Income Tax Act 1961. So these are the certain exemption that has been given for the non-residents based on the concept of mutuality or for the larger benefit for the international cooperation and economic cooperation. So friends, we discussed section 6 residential status, section 5 scope of total income, and section 9 income deemed to accrue and arise in India. This is very important. These three sections are very important for taxation of non-residents, and I hope I tried my best to explain it to you, and will be coming forward again with a new topic on international taxation. Looking forward to hear from you any feedback. Thank you so much. Goodbye.